Welcome, Chairman Powell. I want to start asking about the FOMC, the Federal Open Market Committee's latest forecast. It predicted that core inflation will fall below 3% within a year. This forecast has been the exact same for each Fed meeting over the past 2 years and has been wrong each and every time. Why do FOMC participants continue to make the same forecast, sir, and what data are they reviewing to make this forecast?
So in the world of economic forecasting, we don't really have any advantage over private sector forecasters who've been at this. There's a number of private sector forecasters that are well-resourced, and the data are all public. We don't have private data. That's not how this works. And I think essentially all forecasters have made the same mistake, which is at the beginning thinking that the supply chain problems would be resolved quickly and workers would come back to work quickly and things like that. It's just been, inflation has consistently surprised us and essentially all other forecasters by being more persistent than expected. And I think we've come to expect that and expect it to be more persistent. And
it seems that we've moved way past the whole transitory thing, and for 2 full years now they've been saying it's going to be under 3%, and clearly they've missed that. So it was just a little concerning to me if there was something that we're missing. Let me move on. In your press conference last week, sir, you stated that, and I quote, "The conditions we need to see in place to get inflation down are coming into place." What conditions are you seeing that show that we're moving in the right direction? Because I can tell you, my constituents are still feeling great pain of this inflation that continues to persist.
So there's underlying conditions that I'll mention, but the point is you get them in place, and then the process of inflation moving down will take a significant amount of time. And we've been consistent in saying that. And the conditions I mentioned would be, first, we need economic growth to be slower to be modest, and it has been at modest levels, so that's happening. Secondly, we need the supply chain bottlenecks to go away and get better and improve. And thirdly, we need the sort of mismatch between demand and supply in the labor market to diminish. And that has been happening. So all of those things are happening much later and much more slowly than we would hope. And my committee and I do believe that the process of bringing inflation down is going to be a relatively lengthy one, longer than we expect.
Well, it's clear that the spending on consumer services, for example, a car oil change, a haircut, or a concert ticket, remain almost unresponsive to rate hikes. Do you have a projection for when we might see this spending go down?
So non-housing services, the broad service sector is famously less responsive to and less focused on rate hikes and the cost of capital. So what we think, and that's about half of core inflation, a little bit more than. So we think, and I think broadly, this is what forecasters think, is that it will take some softening in labor market conditions, because in that service sector, it's very labor intensive. By far the largest cost for most service companies is labor. So what you want to see is rebalancing so that demand for labor and supply, a lot of that can happen through fewer job openings and things like that, and we do see it happening.
The Consumer Price Index, or CPI, which measures the price of everything from groceries to cars to rent, has in fact declined from its peak. But this personal consumption expenditures, this is the PCE index, which measures, as we were talking about, consumer spending, remains historically high. How else can you account for this difference when it comes to a rate hike pause?
Well, we never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
Yeah, I think you're right. More rate hikes likely are needed to bring inflation back down to the 2%. And, we're concerned about a hard landing, about recession. So anyway, my time has expired, and I now recognize a gentleman from Illinois, Mr. Caston, for 5 minutes.